Good morning. My name is Myron Frans. I'm Commissioner of Minnesota Management and Budget, and I'm joined today by State Economist Laura Kalambokidis and Budget Director Britta Reitan to present the February forecast. You can review today's forecast documents online on MMB's website, mn.gov/MMB, under the Forecast and Updates tab. Our online materials provide additional details. Today we are forecasting a positive balance of $1.052 billion for the 20 and 21 biennium. The budget balance is $492 million less than the November forecast, which was $1.544 billion. Our forecast has been lowered today because we have reduced our revenue projections over the next 4 years. We made this reduction to revenue projections because, number one, we were forecasting a reduction in economic growth in the future, and number two, we have seen a reduction in actual revenue receipts since November. As a result, our budget outlook has weakened since November. Today's forecast balance projected for $1.02 billion for 20 and 21 is in addition to our reduced revenue projections. We are also projecting some reduction in expenditures that will offset part of the reduction in revenues. Dr. Kalambokidis will discuss the economic outlook and revenue projections, but first, Budget Director Britta Reitan will discuss the budget changes.
I'm Britta Reitan, State Budget Director, and I'm going to walk through the math for the current biennium and the biennium for fiscal years 20 and 21. So this first slide shows the change in the budgetary balance in the current biennium since the November forecast. As you can see in the lower right-hand corner, the overall budgetary balance for fiscal years 18 and 19 has declined by $157 million since November. Revenue estimates have decreased by $198 million, and expenditure estimates have declined by $41 million. There is no change in the budget reserve in this forecast. The budget reserve balance remains at $2.075 billion, and the cash flow account remains at $350 million, for a total of $2.425 billion in the cash and budget reserves. There is also no change relative to the previous forecast for the stadium reserve, which remains projected at $50 million by the end of fiscal year 2019. The changes in revenues and expenditures leave us with an estimated balance of $563 million, which is available to balance forward into the next biennium. The amount of this balance forward, again, has declined by $157 million compared to our November forecast. So moving to the next slide, this slide provides the updated budgetary picture for fiscal years 20 and 21. And this is where you can see the $1.052 billion that is now projected to be available in the upcoming biennium. That's in the bottom row in the middle column. This is comparing the November forecast to the February forecast and then highlighting the change. Walking through the numbers, you can see that the beginning balance declines by $157 million from the previous forecast, and this is what I just walked through on the previous slide. Revenues have decreased by $386 million, and expenditures have declined by $51 million compared to our previous forecast. And again, there's no change in the cash and budget reserves or the stadium reserves relative to the previous forecast. However, the stadium reserve is still projected to grow by $48 million compared to the current biennium, reaching $98 million by the end of fiscal year 2021. The changes in the beginning balance, revenues, and expenditures lead to an overall reduction since November of $492 million and a projected balance of $1.052 billion. We will provide further detail on the drivers of the expenditure and revenue changes a bit later in the presentation, but now I'll hand it over to Dr. Kalambokidis to walk through the economic outlook.
Hello. So I'm going to start by talking a bit about the outlook for the U.S. economy and how that outlook changed since we last prepared a forecast in November. I will then move to Minnesota's economy and finally to the changes in our revenue forecast. The first chart compares the current U.S. real GDP forecast by Minnesota's macroeconomic consulting firm IHS to their prior forecast. The dark bars show the history and their February 19 outlook, and the light bars show their November 18 outlook. Focusing on years, so if you focus for a minute on the years 18 through 20, you can see that the near-term outlook for U.S. economic growth, especially this year, 2019, has weakened since our forecast was last prepared in November. Lower estimates of growth at the end of 2018 led IHS to lower their expectations for this year's real GDP growth from 2.7% in the November outlook to 2.4% now. They also lowered their forecast for 2020 from 2.1% to 2%, and they slightly raised their forecasts for 21 and 22. If you look at the current forecast for 18 to 23, so the dark bars on the right side of the chart, so those bars on the right side there, you can see that the pattern of slowing growth through our planning horizon carries over from the prior forecast. So that's those steps down that you see in the dark bars on the right-hand side of the chart. While current conditions can support moderate growth for much of this year, IHS expects the economy to begin slowing in late 2019. And this occurs as the contribution to growth from the federal fiscal stimulus declines, monetary policy becomes more restrictive, global growth weakens, and a strong US dollar relative to our trading partners' currencies pulls down net exports. And then in addition to that, after mid-2020, IHS expects a demographically driven decline in the labor force participation rate for the United States, so a decline due to the aging of the workforce. And they expect that to slow the economy even more after 2020. So that downshift continues as growth decelerates from 2.9% annually in 18 to less than half that rate in 2023. The history on the chart, so on the left-hand side here, so it's the history of the years since the recession of 08-09 to now, illustrates one of the risks to this forecast. The dotted line is at 3.1%. That's the average annual real GDP growth for the 20 years prior to the Great Recession. So prior to the Great Recession, we could expect annual real GDP growth in the 3s. But that is much higher than what is in our current forecast. And when the economy grows slowly, there's not as much margin for error. It's harder to recover from a setback than when the growth is higher. And the US expansion is expected in a few months to break the record for the longest expansion set in the 1990s. So in this forecast, it will indeed, if this forecast holds, it will indeed break that record. A mature, low-growth expansion is particularly vulnerable when negative economic shocks occur. This chart compares Minnesota's labor market performance to the nation's. The chart shows the headline unemployment rate, where the light line is for the United States and the dark line is for Minnesota. The vertical gray bars show the US recession, so the white space between the gray bars represents the recovery and expansion periods between recessions. Minnesota's steady economic performance continues even as the US expansion, as I said, approaches record length. But the state's ability to add jobs appears to be reaching the limit set by slow labor force growth. That slow labor force growth has been long forecast due to the aging of the population. Throughout the expansion, Minnesota has steadily added jobs, driving the state's unemployment rate well below the US rate. Our unemployment rate currently stands between the low points of the prior two expansions at 2.8%. You can see that it's 0.3 percentage points above the low point for that record expansion in the 90s. It's more than 1 percentage point below the US rate, half a point below where we were last year, the 7th lowest among states and the lowest we've seen in 18 years. The next chart illustrates, in addition to that low unemployment rate, it illustrates Minnesota's tight labor market. The height of the gray bars shows the total number of unemployed people in the state of Minnesota, and the dark bars, the height of the dark bars shows the number of job vacancies statewide. So in the height of the gray bars, you can see the peak of unemployment during the recession, and then you can see how that steady job growth I mentioned during the recovery and expansion has gradually whittled that number down. The dark bars show that job vacancies statewide have grown to a very high level. The ratio of unemployed persons to job vacancies statewide has been less than 1 over the past year and is now down to about 0.7. That means there are fewer unemployed job seekers than open positions across the state. And that tight labor market is being felt across Minnesota. So that ratio is below 1, both for the metro area and for greater Minnesota. The large number of open positions across the state illustrates strong demand for labor, and we expect that demand to persist in this forecast. But as retiring baby boomers dampen growth in the Minnesota workforce, our ability to continue to add jobs is increasingly constrained, and employers and job seekers have to become ever more creative to match people to jobs. As employers and job seekers adjust to this environment, Minnesota's labor market appears to be slowing down. Since last August, the unemployment rate is held at 2.8%, so it hasn't gone down since then. It's held steady there. And that, as I said, is just above the low point for that expansion of the 90s. And between 2011 and 2017, Minnesota employers added, on average, 42,000 new jobs each year. But in the 12 months ending December 18, employers added little more than half that many. Now, those data are subject to revision, but this could signal that we are feeling the impacts of a constrained labor force. So one important way all of this feeds into our tax revenue forecast is through our forecast of total Minnesota wage and salary income. And by total wage and salary income, I mean adding up all of the payrolls of all the employers in the state of Minnesota, and then we estimate how that number is going to grow over time. We continue to expect that number to grow. Wage and salary income will grow every year in this forecast, but we now expect weaker growth than we expected in November. The forecast reduction is due to several things. It's due to a downward revision to 2018 employment data. Okay, so those smaller job gains that I mentioned, those data are lower than what we thought we had when we did the November forecast. Lower than expected wage income growth last year. So again, a lower wage growth number than we thought we had in the November forecast. Recent weakness in Minnesota's income tax withholding receipts. So we look at withholding receipts and infer from that wage growth. And a lower forecast for U.S. wage income from IHS. So this lower wage and salary income growth number Minnesota's is reflected in a lower number for the United States. And as a result of slowing employment growth, more of Minnesota's growth in total wage income is expected to arise from higher earnings per worker and less from increases in the number of people working. So moving to the revenue forecast, the first two columns of this table show the current forecast and the forecast change for the current biennium, FY 18-19, and the right two columns show the current forecast and the forecast change for 2021. Total general fund revenues for FY 18-19 are now forecast to be $198 million less than the November forecast. Lower expected individual income and sales tax revenue more than offsets higher forecasts for corporate and other tax revenue. The largest dollar amount change, as you can see in the chart, is in the current biennium, is in the individual income tax, which is forecast to generate $403 million less than in the remainder of FY19 than we had estimated in November. So far in this fiscal year, net income tax receipts are below our prior forecast, so that lowers the starting point for this forecast. So those lower revenues and lower forecast income growth, including that lower growth in wage and salary income that I mentioned, contribute to the reduced income tax forecast. Sales tax revenue in FY 18-19 is now forecast to be $19 million less than the November forecast. The lower revenue forecast is primarily due to lower forecast growth in taxable Minnesota sales. So when we forecast the sales tax, we look at U.S. forecasts for spending on lots of different types of items, lots of different spending types, and we construct a proxy for Minnesota's sales tax base from all those different spending types. So all the things that are included in Minnesota's tax base, we look at the U.S. forecast for spending in those items. And that proxy sales tax base is expected to grow more slowly than what we had expected in November. That's consistent with that lower U.S. economic outlook that I showed you on the first slide. So lower economic outlook was also lower consumer spending. lower growth in consumer spending. The corporate revenue forecast is up 130 million, primarily due to higher than expected receipts so far this fiscal year. The Federal Tax Cuts and Jobs Act of 2017 made some big changes to corporate tax law, and businesses had to decide how to respond to that law. For example, some of the higher than expected corporate tax collections we've seen so far this fiscal year may have been due to corporations shifting the timing of their income to take advantage of the lower federal corporate tax rate in 2018 and not higher corporate tax liability in Minnesota. We had to make assumptions about how much of this revenue is due to income shifting and how much is actually a higher base of liability from which to start our forecast. So those estimates introduce risk to the revenue forecast. The forecast change for the next biennium shows a similar pattern. Lower forecast individual income and sales tax revenues more than offset a higher corporate and other tax forecast. And that lowers the revenue forecast for 20 and 21 by $386 million. And the dynamics in the next biennium are similar to the dynamics in the current biennium. Lower starting points for the income and sales taxes, so that lower current biennium forecast lowers the starting point for the next biennium forecast. Those lower starting points for income and sales taxes combined with lower growth in taxable income on the income tax side, and lower growth in taxable sales on the sales tax side, to reduce the 2021 income and sales tax forecasts. And a higher starting point for the corporate forecast raises our expectations for FY 20 and 21 corporate receipts. So if you'll recall that deceleration in economic growth I showed you in that first slide, that deceleration over our planning estimates, note that growth in total revenues is also declining over the 3 biennia included in this forecast. Revenues are still growing across all of these years, but the pace of growth is slowing. So on this chart, we illustrate that between the last biennium and the current biennium, total revenues grow on annually 3.2%. And then moving to the next biennium, 2021, that growth slows to 3% per year. And then by the end of our planning estimates, that growth has slowed to 2.3% per year. And Budget Director Reitan will explain how that affects our planning estimates. So let me conclude by drawing your attention to some of the risks to this forecast. The Federal Tax Cut and Jobs Act made big changes to federal tax law, and individuals and businesses are still had to decide how to respond to the law. But we haven't yet seen Minnesota tax returns for 2018, and we're still dealing with uncertainty about how taxpayers actually did respond to those changes and how their choices affected Minnesota tax revenue. The uncertainty about corporate receipts that I mentioned earlier is one example of that kind of risk. So while Minnesota's law stayed the same, changes that people made in response to the federal law affected what they paid into the state of Minnesota. Minnesota's employment gains appear to be increasingly constrained by slow labor force growth, but that is baked into the current forecast. But if labor force growth grows even more slowly than we expect, our employment forecast is at risk. And our forecast of total wage and salary income depends on higher earnings per worker as employment growth slows. This forecast, moving to some US level or global level uncertainties or risks, this forecast assumes that all of the US tariffs and retaliatory measures that were put into place last year are permanent. But as you know, US trade policy, especially regarding China and regarding the new NAFTA agreement, has been in flux. So prolonged uncertainty about trade policy can slow down business investment, and that can affect GDP. I talked about slowing global growth that's baked into this forecast, but with slower global growth, geopolitical events can derail global growth. For example, if the UK exits the European Union without an agreement, that can disrupt exports and that can disrupt global growth. And then finally, with 28 months before the end of FY 20 and 21, we have not yet seen any of the total revenues we forecast for those years. Even small changes to assumed growth rates, especially in particularly volatile sources, income sources like capital gains and corporate profits, could materially alter the budget picture into our planning horizon. So I'll now turn it over to Budget Director Reitan.
So I'll quickly walk you through the expenditure side of the forecast. Expenditures are down relative to forecast in each biennia. The slide focuses on the changes in fiscal years 20 and 21. The overall change in expenditures is actually very small in this forecast, just 0.1%. E12 education expenditures are down $48 million from our previous forecast. This is due to lower actual student counts and lower free and reduced lunch concentration rates. This is partially offset by an increase in special education aid. The change since the previous forecast is less than 0.2%. Property tax aids and credits have increased relative to the November forecast by $29 million in fiscal years 20 and 21. This is largely due to growth in property tax refunds for homeowners. This increase is based on an increase in the actual payments made to homeowners this year and slower projected income growth assumptions into the future. Health and Human Services expenditures are forecast to be $30 million or 0.2% lower in the next biennium compared to our previous estimates. Medical assistance spending is up $13 million from the November forecast and is driven by higher spending in long-term care programs. That increase is more than offset by lower than expected spending in other forecast programs. $32 million of this change is due to lower spending for chemical dependency treatment. The debt service forecast and the all other category of spending is virtually unchanged from the November forecast. Moving to the next slide, this slide provides a look at the planning estimates in fiscal years 22 and 23 and shows the structural balance between revenues and expenditures in both fiscal years 20 and 21 and fiscal years 22 and 23. That means it removes from the chart the impact of balance forwards into those bienniums and the impact of changes in the reserves. You can see in this chart that the structural balance declines into the planning years, and on a structural basis, the number is actually very slightly negative in fiscal years 22 and 23. I also want to highlight that this view is just representing the structural balance in the general fund. Not included in this total is the projected deficit in the Healthcare Access Fund. With the expiration of the provider tax, the Healthcare Access Fund is now forecast to have a $919 million deficit in fiscal years 22 and 23. Also, I want to highlight on the right side of the chart, you can see that projected annual growth rates of spending and revenues between 2021 and into 22 and 23. Spending in the general fund grows over this period at 2.9% annually, which exceeds the 2.3% annual growth in revenues. The biennial growth in expenditures shown here is just the growth that is occurring in forecast programs. The biggest driver is the growth in medical assistance. And then at the bottom of the chart, you can see an estimate of inflation. Inflation is generally not included in the expenditure estimates within the forecast, except in those programs where there is an inflationary component in a formula or where the formula is based on actual costs. Some examples of places where inflation is included in our estimates is property tax refunds, special education, a portion of healthcare, and in debt service. The estimate of inflation included on the slide is only applied to those expenditures where inflation is not already included, and it's based on the Consumer Price Index as the measure of inflation. It also compounds over 2 years into fiscal years 20, 21, and over 4 years in 22 and 23. So that's why you see the growth out into 22 and 23 in that inflationary estimate. And then I'll pass it back to Commissioner Frans.
As we examined our forecast from last November, we have confronted a number of uncertainties as described by Dr. Kalambokidis. The 2017 federal tax bill continues to be a source of uncertainty in trying to predict how taxpayers reacted last year and how they will react this year. During the last 3 months, the U.S. economy has also continued to face trade policy uncertainty, and our consultants, IHS, have lowered their U.S. GDP projections. All of these uncertainties are reflected in this forecast. As you know, we are in the first year of the Walz administration, and we released our budget proposal last week and our bonding proposal on Tuesday. Our budget outlook has weakened, even though we continue to forecast a balance of a little over $1 billion for 20 and 21. It's important to note that all of our spending for 20 and 21, as Budget Director Reitan mentioned, does not include the impact of inflation. If we were to include the effect of inflation, we would need to add an additional $1.1 billion of spending to this forecast. We must be mindful of this cost pressure in the budget process so we are able to fund services at current levels. This administration faces these new economic and budget concerns with a $2.4 billion rainy day fund, a AAA credit rating by the bond agencies, and a recently enacted pension reform bill. We added $491 million to this reserve in November of 2018 as part of our smart fiscal policy of an automatic budget addition in November when there's a balance. As you will recall from the governor's budget proposal last week, the governor was cautious about the changes that this forecast might bring, and we left $789 million on the bottom line to better adjust for these lowered projections. So we must now, with caution, address these different changing projections as we go forward, and over the course of the next several weeks, the governor will review his budget, and he'll be out in a few minutes after we get done answering questions to talk about how he's going to view this as he goes forward. But with that, we're happy to take questions, and once we're done, we'll invite the governor out. Any questions? Yes?
So you account for inflation is one way to look at it is there is no surplus?
Well, yeah, the inflationary projection for the spending would exceed the actual budget balance we're projecting for 20 and 21.
So is this really a shortfall, or is it a surplus?
Well, we've struggled with this issue since 2003, and I think one of the issues that we have to address, and it's one of the reasons the governor proposed making some changes in his budget proposal to add inflation back to several tax revenue positions, is we need to start addressing this. The governor does want to address this. He's mentioned this before, and one of the goals that we will have over the next several years is to figure out ways to bring inflation back into the budget cycle to make it more reflective of reality. But this is the reality that we face, and we face it every year, every budget session, time after time. It's something we're going to have to address.
I think you used the word surplus. I think you said positive balance. Is that on purpose? Is there a reason?
Yes, so we have a surplus in the fiscal year 2019. We have an enacted budget, and we actually are projecting a surplus in that budget in that year. We have a projected balance in 20 and 21 because we do not have an enacted budget for 20 and 21. That's how we make the distinction between a surplus and a positive balance going forward. And then in the 22-23, it's either a planning balance or a planning deficit, depending upon the situation. In this case, it's an $11 million or a 0.02% deficit in 22 and 23. Glum. Why do I sound so glum? I'm not glum. I'm just as happy as can be. Well, I told the governor, when you look at the labor shortage and the tightening labor market, I said one of the best things he could do for the aging baby boomer population is to keep me employed in order to keep down that reduction in the workforce. He seemed to react positively to that, so I'm pretty happy about that. I'm not glum. I think it's a cautionary tale, clearly. When you take $500 million out of the projection for 20 and 21, that's a concern. So just to do the high level numbers, we had about $1.9 billion in projected balance for these 4 years, and we've taken out about $959 million from that projected balance. So there's a $492 million reduction in 20 and 21 and a $467 million reduction in 22 and 23. So those are not the numbers I'd prefer to see, but they're numbers that we can manage and work within. And I think after already briefing the governor this morning, looking forward to ways to enact a budget he thinks is the right policy decision. I think that's the key here is understanding that we're still in a positive situation, but we need to be cautious about how we proceed. We need to make sure that we look to whatever revenue changes we make or whatever spending we do has got to be balanced for the long term. And one of the things that the governor and I talked about already this morning was if there's ever a case to really protect the general fund, for general fund functions, it is now. I mean, we've always made the argument that the general fund is for education, it's for healthcare, it's for some healthcare, it's for public safety, and it's and when you start dedicating the general fund to transportation, and so one of our issues that we've talked about is the $460 million that's currently dedicated in the general fund for transportation. The governor's tax and transportation proposal would replace that with the sales tax or the increased gas tax. So our fundamentals remain the same. We need to protect more than ever now the general fund to make sure it's used for those things, and transportation and transit should be funded separately outside of the general fund. Same thing in the provider tax. If we don't take care of the provider tax now, it is going to have a general fund effect soon. So these signs indicate that we need to be cautious and really thoughtful about the policies that we enact. So
Surplus takes you out how far?
I'm sorry.
Provider tax surplus takes you out how many years?
So the deficit occurs in 22 and 23. So it rolls forward after this year when if it would sunset, it continues, and then the deficit hits in 22 and 23.
Dr. Kalambokidis, if I may. Doctor, it appeared that the factors you were citing about the change in Minnesota were either national or global or demographic and not peculiar to Minnesota policy. I want to be sure I'm hearing that correctly and wonder if there are any particular Minnesota policies that you would lift up either as contributing to this slowdown now or as remedies for blunting the slowdown going forward that you would recommend.
So you understood correctly that that the factors that we start with the U.S. economy, and that the factors contributing to the slowdown are mostly coming externally. So they're external risks. Minnesota's economy is closely tied to the U.S. economy, and so we tend to follow that. In terms of factors that or policies that could help in this environment, where the main factor I cited is the tightening of the labor force growth, is I would say that Minnesota needs to continue to be a place where people who are looking to relocate from other states and from around the world, it needs to look like a place of choice. And so we need to continue to be attractive to folks. One of the bright spots in our labor force story is that in both 2017 and 2018, we now know that Minnesota gained people on net from other states, reversing a 15-year pattern where we lost people to other states. And so we need to continue to be the place that people choose. In addition, for any given amount budget, looking at that whole portfolio of options and targeting investment to programs and policies that will strengthen our workforce and lower barriers to people entering the workforce. So we do not have a deep bench of people on the sidelines in Minnesota, but we do need to make sure that everyone has an opportunity to join this workforce. And so lowering barriers, making it seem attractive. But the challenge with regard to a slowing labor force growth is something that employers are facing. And so they are the ones who also have to be more creative about their own, the way they operate, the way they look for workers, the way they hire. They're having more flexible workplaces, raising wages, all of those things.
Doctor, are we headed into a recession?
Go back to the first slide. As long as these bars represent real GDP growth, as long as these bars are above the horizon, as long as they're going up, that means GDP is growing. And so in this forecast, this is a recession over here where it goes down below, right? So we don't have that in this forecast. So IHS and other macroeconomic forecasters are expecting this slow growth to continue. There are risks to the forecast that could turn that around, some of which I've cited.